Anthony Grasso here, bringing you financial news that you could use. In this video, I'm going to do a stock analysis on Uber Technologies. Is Uber worth investing in right now, or should we be worried about the looming class action lawsuits that's happening? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst predictions, and then finally I'm going to give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. As always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell if you like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. All right, so this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. Now, if you sign up today and deposit any amount, you get up to 12 free stocks by using my referral link that's in the description down below. All right, so everybody should know what Uber is by now. They've become one of the largest on-demand ride-sharing providers in the world. Now, that's except for China, of course. Now, they operate in the United States, Canada, Latin America, Europe, the Middle East, Africa, and the Asia Pacific. They offer three segments: mobility, delivery, and freight. And we all know the mobility segment. It provides consumers with the mobility drivers who provide rides in a range of vehicles such as the cars, auto ride shares, motorbikes, minibuses, or taxis. It also offers financial partnerships, transit, and vehicles solutions offerings. Now, the company has completed over billions of miles and trips. And at the end of 2020, Uber had 93 million users who use the firm's ride-sharing or delivery services at least once a month. So now let's look at some of the news of the company right now. Now, there's definitely a class action lawsuit that's going on with Uber at the moment. Uber's had years of bad press. They touted changes to its top management and reforms to corporate culture. And they currently try to position themselves as the company had atoned for the prior compliance and cultural issues. Now, according to this lawsuit, it claims that Uber met secretly with various government officials and politicians to skirt laws and regulations around the world and risk driver safety to advance the company's interest. Moreover, the Uber files disclosed that the foregoing conduct was known to and in fact encouraged by the company's top management, the lawsuit claims. Now, the news came out back in July and the shares fell roughly about 5% back then. Basically, the lawsuit looks to cover all the persons and entities who purchased or otherwise acquired Uber common stock between May 31st of 2019 and July 8th of 2022. And if you've personally had the stock, I would recommend contacting this law firm for more information. Now, it is accurate to say that they're currently turning around its culture and compliance issues. Now, I really think that the company will end up settling this in the long run and hopefully turn around to become a better company. Now that we have that out of the way, let's go ahead and look at the company itself and then decide as if this company is worth investing in from a fundamental standpoint and where their growth potentials are. All right, so the stock is currently trading at $29.14 a share. It's definitely up from, its Friday lows. And it has a market capitalization of roughly $56.6 billion. Now, the first thing I want to do is look at the current valuation of the company and look at some key numbers of the company. Now, because the company has negative earnings, the price to sales ratio and the price to book ratios are the most appropriate valuation measures. Now, Uber does seem expensive with its price to sales ratio of 2.2 times compared to that of the U.S. transportation industry of 0.9 times. But it's a good value compared to its peers. The peers have a 2.3 times price to sales ratio. So it's right in line with them. And if you look at the price to sales ratio versus the fair value of the company, taking into account the company's forecasted earnings growth, profit margin, and other risk factors, it does seem like a good value based on that, because the estimated fair price to sales ratio is 3.2 times. So it's 2.2 times and its fair value is 3.2 times. Now, finally, if you look at the share price versus fair value when looking at the future cash flows using the discounted cash flow model, it's trading below our estimated fair value of $80 a share. So basically, I think the company is valued correctly at this moment in time. Now let's look at some of the company's profitability numbers. Now, they are losing money on a net basis. Uber appears to be an inefficient company currently, but they do have high growth earnings potential and is expected to be profitable over the next 3 years. Now, when we look at the company based on its growth, it's the earnings decline was in spite of positive revenue growth during the past 12 months. Now, these revenues are projected to increase over the next few years from an estimated $31.24 billion by the end of 2022 up to $44.5 billion by the end of 2024. Now, earnings are forecasted to also grow, but by 78.8% per year. The earnings are forecast to be a negative $8.8 billion by the end of 2022, but significantly get better and increase to become profitable in the 2023 or early 2024, with estimated positive $1.24 billion in earnings by 2024. Now, if you only examine the current company situation without looking forward, the company looks blah blah right now, and it's like, they're just but you have to look at their future growth potential to really examine Uber going into the future. Now, finally, let's look at the financial strength of the company. And the net debt to equity ratio of 67% is considered high right now. Now, the debt to equity ratio has increased from 63% to 126% over the past 5 years, so it hasn't been good. And its short-term assets of $8.8 billion do not cover its short-term liabilities of $8.9 billion, nor cover its long-term liabilities of $14.5 billion. Now, while it's unprofitable, though, Uber has sufficient cash runway for more than 3 years if it maintains its current positive free cash flow level, which I believe it will. Now, it's important to note that there's been insider selling over the past 3 months by 2 individuals, Jill Jazelbecker and Derek West, which is always a concerning thing to know that insiders are selling out. But if you look at the previous 3 months to 12 months, the current CEO of the company was buying shares of the company. And it's also important to note that shareholders have been diluted in the past year about 5.1%. So I'm thinking with their current strategy in place on getting the profitability by 2024, hopefully we won't see any more share dilution, but it's always a positive thing. Now, let's go ahead and look at what do the current analysts say regarding this company. Well, the current recommendation is a buy recommendation, and they put an average price target of $47.55 a share over the next 12 months with a high of 76 and a low of 26. And finally, going over a few of the analyst reports that I could find, the Street Quant Ratings over here, they have a sell recommendation on Uber. Now, this report says the company's weaknesses can be seen in multiple of areas. They claim that the disappointing net return on equity, poor profit margins, generally disappointing historical performance in the stock itself, and it says they have feeble growth in its earnings per share. Yes, I do agree that historically that statement is true and accurate, but I'm more concerned about the future growth potential at this moment in time over the next 12 months. And the Forward Equity Research Report also has a sell recommendation, but and they say that Uber will underperform the market over the next 6 to 12 months, and they put greater weight on historical earnings per share trend as a measure of earnings strength. I don't. I look at their growth potential and where their growth numbers are going. And the only report that has a buy recommendation is the CFRA report. Now, they have a favorable view for both the mobility and delivery segments, coupled with their belief that it will be disciplined on cost. I believe that sentiment as well. Now, they say Uber as a share taker like emphasis on product innovation and see many levers to pull to control costs. And I do agree that there's a lot of things that the company can do to reduce its cost structures. Now, the CFRA report also said it's expandable, it's addressable market. They did recently acquire Drizzly, Postmates, and Transplace, while they also created a more flexible business model to support varying industry conditions, like selling self-driving unit. Now, the CFRA report puts greater emphasis on subscriptions, offerings, and advertisings put in a good position to see the free cash flow in 2022 and net profitability in 2023. I agree that the free cash flows, but I think it will be at least to the end of 2023 before it becomes profitable. And let me bring it back over here. So based on all that information, am I buy, hold, or sell recommendation on Uber. Now, here are my thoughts. Yes, the company has been on a bearish trend over the past year. What I am focused on if they can hit that profitability mark. So first, let's review their latest second quarter results. Now, the supply side of Uber continues to improve because there's higher demand with increase in driver and vehicle use across the United States. Now, Uber now has their subscription-based offerings called Uber One, and they have over 10 million members. And that growth is likely to expand its profit margins significantly. Now, some people wonder why, what about inflation and its impact on Uber? Well, so far, there hasn't been a significant impact, nor that looming threat of an economic recession has weighed on Uber right now. Now, gas prices have come down from their all-time highs, which is going to help the drivers say, I can afford to actually work for Uber to actually deliver things, right? Now, Uber's mobility segment has continued to impressively grow, like impressive numbers. Now, while on the other hand, demand for the delivery displayed resilience after the pandemic. Now, Uber users and trips are approaching pre-pandemic levels, all-time highs, which is great for the company. Now, Uber for 2 quarters in a row have seen all business segments generate a positive adjusted EBITDA. Now, Uber also generated free cash flow for the first time, which management expects will continue, and also agree with that sentiment. Now, I remain confident that Uber will hit its profitability mark in 2024 as the network effect drives operating leverage. So based on all of that information, I am a buy recommendation on Uber, and I put a 12-month price target between $45 to $50 a share. Now, I believe that Uber has 30% global market share and will be the leader in my estimated $452 billion total addressable ride-sharing market by 2024. Now, I believe that the firm's food delivery service will continue to be one of the main revenue growth drivers. Both the mobility and delivery segments will continue to benefit from cross-selling opportunities on the demand and supply sides of the platforms. The utilization of Uber's overall on-demand platform for delivery services in the other verticals can also help the firm's progress towards profitability, in my view. Now, if you're a bull on this company, this is a few of the things that you're going to say. You're going to say Uber's position in the autonomous vehicle race could equalize gross and net revenue after no longer needing to pay drivers. But my opinion is autonomous vehicles is that it's a long way away in my mind. We're not anywhere close to seeing full adoption of autonomous vehicles by any means. Now, bulls will also say that there's pressure to pay a minimum amount per trip to its contracted drivers, which could create a barrier to entry for other smaller players in the market, which would help Uber in the long run, because if you pay your drivers more money on a per contracted basis, those other people that are trying to break in the market, those drivers are going to stay with Uber and Lyft, for instance. And also another bull argument is that that Uber's aggregation of multimodal offerings will drive in-app stickiness, making Uber a one-stop shop for all transport needs. I do agree with that sentiment. Now, here's what the bears will say regarding Uber. Now, they say that development of autonomous vehicles, and especially Google's Waymo, could eliminate the need for an existing rideshare platform, driving Uber and Lyft out of business. Now, I completely disagree with that sentiment. And like I said, we're nowhere close to any autonomous adoption yet, or what the impacts of autonomous adoption is going to be on Uber and Lyft. Now, another bear argument is that the ride sharing is still relatively a new industry, which leaves plenty of room for increasing regulations that could hurt the company. Now, I do believe that there will be heightened regulations, but I don't think ride sharing is going away anytime soon or decreasing usage in the near future. Now, and finally, Uber's public perception has suffered drastically. Just look at that lawsuit in recent years because of the data breaches, and had cultural and sexual misconduct and internal racial discrimination issues. Now, I'm sure that there's going to be some impact to that statement on this lawsuit, and I'm sure they're going to work out their issues. In the end, most likely, they will most likely settle it out of court for an undisclosed amount of money. Maybe this is in the very beginning of the lawsuit, so we have no idea what's going to go on with it. Now, there are risks, though, to my rating and recommendation. There could be, like I said, unexpected changes in the regulatory landscape There could be slower than expected adoption of transportation as a service, and there could be greater than expected competition pressures and longer than expected time span to generate positive free cash flow. But they already hit it, so I'm not too worried about their free cash flow right now. But I personally am not too worried about any of those risks. But what are your thoughts? Please leave your comments down below, and as always, thanks for watching. So there you have it, folks. As always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you like to hear daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.